What if your money could keep working for you even on days when the stock market looks like a roller coaster? What if instead of stressing about every dip, you could sit back and collect steady cash payments from companies that continue paying you no matter what the market is doing? Today, we're diving into a dividend gold mine. 10 U.S. stocks paying 5% or higher dividend yields during one of the most unpredictable years investors have seen in a long time. These companies are handing out income even when everything else seems shaky. And if you stay with me until the end, you might discover one stock on this list that most investors never even look at, but probably should. Before we jump in, ask yourself something. If you could build a portfolio that pays you real money every single quarter, how much pressure would it take off your long-term goals? Drop your answer in the comments, and I'll read through what you think, because understanding your mindset helps shape future videos. Let's start exploring the first set of dividend payers that have managed to stay strong even while the market has been swinging up and down like crazy. The first company is one a lot of income-focused investors swear by, AT&T. It's far from flashy, but its dividend yield hovers around a level most tech companies can only dream of. Yes, the stock price has its ups and downs, but the company still generates huge cash flow from millions of wireless subscribers. The big question many investors ask is, can they keep paying? And for years, they have. If you were collecting dividends from AT&T today, what would you use that passive income for? Debt? Investments? A small vacation? Leave your answer below. I'm always curious how people would put their dividend income to use. Next, let's talk about Verizon. Just like AT&T, Verizon brings in consistent revenue from the same massive telecom space, and its dividend sits above the 5% mark. While some investors think telecom is boring, sometimes boring is exactly what you want in a volatile year. Stability, predictability, cash flow. That's the beauty of it. Even when the market panics, people still pay for phone service. That's what makes these two companies such reliable dividend machines. Now, let's go into a different corner of the market. Energy. When it comes to high-yield dividends, energy companies often sit near the top. One example is ExxonMobil's lesser-known high-yielding cousin, but let's look at one that stands out for income. Enterprise Products Partners. Its yield is often way above the 5% level, sometimes even pushing towards 7%. This company isn't drilling for oil. It's running huge pipelines that transport natural gas, oil, and petrochemicals. That means steady fees, long-term contracts, and durable cash flow even during uncertain markets. And here's something to think about. Would you rather invest in a slow-growth company with a high dividend or a fast-growth company with no dividend at all? Tell me your answer below. I'm really curious. Another energy player worth mentioning is Kinder Morgan. Like Enterprise, Kinder Morgan owns essential infrastructure that the entire country relies on. Its dividend remains one of the highest among major U.S. energy companies. Even when oil prices swing wildly, pipeline operators often remain steady because they earn fees based on volume, not price. That's a key detail most beginners miss. Now let's slide into the world of real estate without buying a single building. Real estate investment trusts, or REITs, are required to pay out at least 90% of their taxable income to investors. That means dividends, dividends, and more dividends. One strong example is Realty Income, often called the monthly dividend company. Yes, monthly, not quarterly. Investors love that. Businesses like grocery stores, pharmacies, and convenience stores rent property from Realty Income, providing incredibly stable rental income. Even when the economy slows down, people still buy food, fill prescriptions, and grab snacks. That's why this company remains one of the most dependable dividend payers in America. If you were getting monthly dividend checks, how would that change the way you think about investing? Drop your thoughts below. Another interesting REIT is Altria's real estate counterpart in the retail space, but let's focus on one that truly stands out. W.P. Carey. It has properties spread across industrial, warehouse, retail, and office categories. The yield is solidly above 5%, and because the company signs long leases, sometimes 10 to 20 years long, investors get long-term visibility into cash flow. That's something rare during volatile times. Speaking of Altria, let's talk about it. This is one of the most debated high-yield stocks in the entire market. With a dividend yield often pushing past 8%, Altria continues paying investors year after year. The company faces challenges as smoking declines, but it also continuously adapts toward reduced-risk products and other revenue streams. Some investors avoid the company for ethical reasons, while others see it as a cash-generating giant. Which side are you on? I'd love to know. Comment your perspective and let's discuss it down there. Another consumer-focused dividend payer is Philip Morris International. If Altria handles the U.S., Philip Morris handles most of the rest of the world. It also generates strong cash flow with a yield above 5%. Investors watching this stock closely often look at one thing: how fast the company's smoke-free product line is growing. That growth has helped support its dividend even during market turbulence. Let's step away from tobacco and move toward finance. One stock income investors often look at is Prudential Financial. Insurance companies might not be exciting, but they're dependable and generate a steady stream of cash from premiums and investments. Prudential's dividend yield usually sits above the 5% line, which is impressive for a major financial company. In a volatile year, financial stability matters more than ever. Now here's another sleeper pick: Iron Mountain. A lot of people think this company only stores paper files in giant warehouses, but it actually handles digital storage, data center operations, and secure document destruction. The yield is above 5%, and the company has been transitioning from a slow-moving storage business into a modern data center-powered operation. It may not have the hype of a tech stock, but it pays much better than most tech stocks. If you could earn over 5% while the company reinvents itself for the digital era, would you take that bet? Tell me in the comments. Before we reveal the final stock on this list, and trust me, it's one investors constantly overlook, make sure you hit the like button, subscribe, and share this video if you're enjoying the content. It helps the channel grow, and it tells me to make more videos like this. Also, what other dividend topics would you love to see? A top 20 list? Dividend traps to avoid? Dividend ETFs? Leave your ideas down below. Now let's talk about a company that most new investors never pay attention to: Medical Properties Trust. This REIT owns hospitals around the world and earns rental income from long leases with healthcare operators. Its yield has often been extremely high, well above 5%. And while the company has faced challenges, it still remains a major player in the healthcare real estate space. Healthcare is one of those industries that keeps operating no matter what the economy is doing, which is why many income investors keep a close eye on this one. Would you be comfortable investing in a REIT that owns hospitals? Why or why not? Share your thoughts below. I'd love to see your reasoning. As we wrap up, think about what all these companies have in common. They operate in industries people rely on every day: communication, energy, real estate, insurance, and healthcare. When times get rough, companies like these don't usually collapse overnight. They keep earning, keep operating, and keep paying dividends. That's why so many long-term investors love dividend stocks. They provide something the stock market rarely gives you: a sense of calm. But remember, even high dividend stocks require research. A higher yield isn't always better. Sometimes it's actually a warning sign. That's why it's important to look at cash flow, payout ratios, long-term business stability, and how much debt a company carries. A dividend is only good if it lasts. Which of the stocks on this list surprised you the most? And which one would you want me to break down in a dedicated video next? Leave your answer in the comments. I read every one of them, and your suggestions shape what comes next on this channel. If you enjoyed this deep dive into the world of high-yield dividend stocks, make sure you like, subscribe, and share this video with someone who wants to grow their income the smart way. The more we learn together, the better investors we all become. Thanks for watching, and I'll see you in the next one.